The year's biggest market bull says put a fork in the tech trade. Chris Harvey is the head of equity strategy at Wells Fargo Securities. Chris, good to see you. I know you could probably explain that to me, but I think that's for another show. You say it's time to move up in quality and down in risk, but we're seeing this rotation out of mega cap tech, which some would argue, many would argue, is up in quality and down in risk. So how do you reconcile what we're seeing going on right now?
Yeah, so what I think we're talking about, too, is you have to differentiate between what's cyclical and what's not cyclical. So software or software and semiconductors are two different beasts. One is much more cyclical, one's much more secular. And what's happening is we're seeing that secular trade really unwind. You're seeing it in the high growth companies, and you're seeing it in Microsoft today. And I think that's partly related to what we're seeing with the Fed. What the market is saying very loudly, and a lot of people don't agree with this, but the market is saying this, is the Fed is not going to make a policy error. By hook or by crook, they are going to contain inflation, or they're going to keep it moderate. Because what you're seeing is the yield curve is flattening with the front end coming up, and you're seeing break evens come down. And that's an environment that's not very hospitable to stagflation. But stagflation is a great environment for these high flyers. Stagflation is a great environment for software, and that's what's changed. More importantly, we've also had a lot of hedge fund de-risking and degrossing in the last couple of days, in the last couple of weeks, and many of them have been crowded into these high growth names and into these software names. We think that's ending, but if you're trading or you're investing on a price to sales basis and not on a price to earnings basis, you're not having a very happy end to the year. Let's just say that.
Chris, it's Karen. Thanks for being on. So if one were to follow your advice, then does that by definition leaving that investor into value stocks, whether it's financials or industrials, is that where you should put your money now?
So, Karen, what we're telling people is we want cyclical quality, right? So we want better balance sheets. We want better stewards of capital, better management teams. We want good secular stories. Some we can find in industrials, such as the aerospace group. We think there's a great secular story there. We think there's good balance sheets, and we think there's great opportunity. We think you can find that in financials as well as particularly banks, but you can also find that in parts of tech, more so in your semiconductors and your hardware type space. So basically what we want is we want good balance sheets, and we do want some cyclicality because we don't think the run's over, but we do want to get more conservative. We do want to downshift a little bit right here, right now.
Chris, we talked about the impact of the retail trader this year. That's certainly been a big headline of 2021. And you had an interesting chart in your latest note, which we highlighted yesterday on the show, the percent of household assets and equities. And it's higher than it has been, at least according to the chart that you have off of all the years that you go back that you show. And I'm wondering how you think this plays out in terms of, if the Fed is going to fight inflation by hook or by crook, that could mean negative things for the stock market, and that could mean a negative impact on household wealth.
So, Melissa, there's two reasons why we highlighted this chart. One has to do with the market. The other has to do with spending. If you look at the last time there was a big spike, it was the late 90s. And really what this told you, when you get this peak, it's more about what has happened, not so much the good times that are about to happen. You've had a really good run in the equity market. You've pulled ahead return. And the next couple of years may not be so great. That's what we saw in the late 90s. That's what we're beginning to think now. On the spending side, as you tie more than net worth to the stock market, at some point the stock market will pull back. That pullback is going to influence sentiment a lot more than it did in the past. And by association or by default, that's also going to influence discretionary spending, consumer spending. And so now the stock market has a much bigger part of the economy today than it did 10 years ago. And that's important to take note of. And that's very, very important as you restructure portfolios.
All right, Chris, good to see you. Thank you.
Thank you.
Chris Harvey, Wells Fargo Securities. Jeff Mills, how do you think that plays out in terms of household wealth and the impact of what we're seeing, at least this week for the stock market as we come off of record highs?
Look, I think it's certainly possible that it has an impact, but at the same time, I feel like households in general are in pretty good shape from a fundamental standpoint. So perhaps that isn't really the main governor on the stock market. When I think about my thesis for next year, again, it's more about price to earnings ratios potentially coming down because the economy is slowing down in general and people become a little bit more risk averse. When I think about next year, and the potential EPS growth, say somewhere around 10%, I think that's consensus. If you get a 1% tick down in the PE ratio, you're talking about a return in the stock market that's somewhere in the 5% range. So I agree in the sense that you may end up with meager returns in 2022, and it's largely because of this slowdown thesis that I'm talking about. I still think, Chris talked about quality. I still think that you can find that quality in certain areas of technology, and we've seen that play out in the past. So that's where I'm focusing my attention as I think about next year.